Welcome to another installment of the ratios. Now we're looking at this ratio quiz that you were given in class. We're going to do that. Now, again, first question. We're being asked about the gross profit. So what financial statement is it? I hope you said income statement or profit and loss statement because that is the one we're looking for. Now, gross profit. We know the ratio, gross profit over sales, and then we'll times that by 100 at the end to get the percentage. But when we go to our statement, we go to gross profit, and I've written some stuff in already, but gross profit actually had this question mark. So we didn't actually know what it was, so we had to work it out. Now that means you've got to remember your calculation, which is... Yeah, I didn't hear. Alright, so sales minus COGS equals gross profit. Alright, so we had to just do a little quick calculation. We worked out that COGS is 450,000. It gives us that. So sales minus COGS equals 150,000. So we've got our gross profit now. So it's 150 over our sales of 600,000. Now I've just dropped the 3 zeros because we can. So 150 over 600, and a quick calculation tells us that it's 0.25. Nice and neat. Now times that by 100, and you actually get 25%, because we've got to turn it into a percentage, remember that. What is the gross profit ratio? We've just done that because I was silly and didn't read the second question. So the value of gross profit, the answer would have been 150,000. Okay, and then that would be question 2. Good job, peoples. We did 2 questions in one. Question 3. What is the return on owner's equity? Net profit over total liability. It gives us the ratio, and you know, or the calculation, the formula. You get that. So net profit over total equity. Net profit 50,000 over total equity. Ooh, hang on a second. It doesn't say it, but additional information. Owner's equity 400,000. So nice. They gave it to us. Now we got to do the calculation. So 50,000 divided by 400 equals 0.125. Okay. Now we'll normally just do 2 figures, but because we've got a 5, we can make it work. So let's convert that into a percentage and times it by 100. So therefore we jump the decimal point to the right twice. Becomes 12.5%. Calculate. We've done it, so we've got our answer. Would you consider this to be a reasonable investment? Why? Why not? Ooh. Alright, what is it asking us? It's asking us that if we were to invest money into it, would that be worthwhile? Now we have to, if we look at question 3, it tells us that owner's equity, that what the owner has invested, has led to achieving a 12.5% return. So this one's telling us owner's equity, or return on owner's equity, tells us how much of net profit, which is all the money we make after all the expenses, so it's the profit we make, what we get to keep. It's saying, based off the investment of the owner, how much of the profit did he generate from his investment? Not from selling goods and services, but just from putting in 400,000, how much did he generate in net profit? And we work out it's 12.5%. So that's pretty good. Now you just need to know that, to be honest. Anything above 10% for return on investment is probably a decent, reasonable one. Higher is better. We could go as high as we want, but 12.5% is decent. So we could say, yes, it's reasonable investment, but we don't have to say why. And we have to then understand what this is telling us, the percentage answer here. So, yes, this is a reasonable investment because the business is generating a return of 12.5% on what is invested. into it. Now that's a very simple way of putting it, but I just want to keep it simple at this point. What is the net profit? Net profit minus sales, or divided by sales. Net P over sales, 50,000 over, so we've got 50,000 over 600,000. So we're back here, 50,000 over 600,000 equals 0.083. So if we times that by the 100 to turn it into a percentage, we get 8.3%. Seems a bit low, like we've running out of a bit of money. Now, what is the net profit? So we've just done that, we've done our calculation, so that question has been achieved. Good job. Now, we're going on to our next one. Calculate and interpret the current ratio of Wizard Pinball Manufacturing assets and liabilities. So we're given the calculation, current assets over current liabilities, 250,000 over 250,000, 1-to-1. This tells us that $1 of current assets covers $1 of current liabilities. The business is able to cover its current liabilities, but is only breaking even and not making a profit. So that's our answer here. Now, we've got a bit of all we need to do here is understand, make sure we know what we understand the ratio to be saying. So our current ratio, which is here, should trigger in your mind current assets, current liabilities. So where do we find them? On the balance sheet. It gave us the information here, so we just need to remember that. Now, 1-to-1, when we do a division, the one on the top, so in this case current assets, will always be the number on the left. Okay, number on the left. But the figure that we have on the bottom of the division is going to end up being the number on the right. So we'll just try to remember that. If you can't remember it any other way, try to just make an association so you can remember left and right, which means 1 current asset is equal to 1 current liability in this case, which means we're just covering it. If we had a drop in our assets, in our asset value, or we increased our liabilities, we'd actually be in a lot of trouble because we wouldn't be meeting our liabilities. So 1-to-1 is a really risky position. It's not terrible, but it's just risky because we're still meeting our assets. We can still meet short-term debts like an overdraft. Hopefully you can think of another short-term liability because you'll probably need to in your exam. Alright, so I'm just going to pause it there for now.